Today on InvestTalk, we give an update on earnings season. We then discuss how markets performed today. Then I answer questions about Micron, Social Security, covered call ETFs, and more. And at the end, I unpack whether a struggling commercial real estate sector will bring down markets.
This is InvestTalk, independent thinking, shared success.
My main focus point today concerns the industrial sector and what to watch when it comes to the earnings picture as we head into peak earnings season. Now, there's a lot of earnings this week, but really peak earnings is next week, November 3rd through the 9th. And then it kind of trickles off. You get a little bit in the week after, not very much the week after that, and then the final surge as we close the month of November in Thanksgiving week. And so, but once you get through next week, you're going to have over 3/4 of earnings reported. And so far, it's been kind of a mixed bag. Last week, you had GM. They beat expectations as well as raised full guidance, but the market pushed up 10% on the day. Philip Morris, another big bellwether, up 9% as they raised earnings per share guidance. Verizon and Lockheed Martin, however, they saw disappointing earnings and both stocks fell on the news. And then you have Tesla and IBM on Thursday. Tesla had a good reaction, even though their earnings quality was poor. IBM also had mixed results, but and that fell a bit on the news and has continued to do that pretty much every day since that earnings report. And nearly 20% of the S&P reported through the end of last week, and year-over-year growth rate is 3.4%. That's the fifth consecutive quarter of growth, yet the lowest growth rate in over a year. But still growth nonetheless. And that kind of mirrors what we talk about with GDP. Everyone says, oh, you're in a recession. Well, based on the earnings, it tends to ebb and flow with the overall economy, and earnings do continue to grow, even though not at a very fast clip. Now, 1,536 global companies are scheduled to have reported Q3 results by the end of last week. But energy and industrials were the ones that were the biggest drag, so showing negative growth on the top and bottom line. Now, energy, that's obvious. You had oil prices down. They can't help it. They're price takers. So if oil prices are down, energy is going to be down. Now, industrials, that's another story. That has more to do with industrial production and whether they can control their costs and grow their sales, et cetera. But they haven't been able to do that. Now, the biggest drag in that is actually Boeing continues to struggle there. Now, interesting enough, they had some pretty high volume today on Boeing. So that may tell you there's an inflection point coming in Boeing, but they are the ones, at least on the earnings front, that are dragging down the most. You had Honeywell, Southwest Airlines, and UPS all released results late last week. UPS and Southwest, they beat on earnings and were up on the day. Honeywell was a slight miss, and so that is another industrial bellwether that certainly took it on the chin. It was at 220, now all the way down to 205 after that report. But like I said, you're going to get a ton of earnings reports this week and next. You had Google after hours that was up nicely. You had Reddit up to an all-time high. You had Google up, let's see. Give it to me. There we go. It closed the day around 170, and now we're at 178. So a nice little boost for Google. So we're in the midst of earnings season. So far, really so good. And you can't really fault any sector that's falling out of bed too much, and that continues to give credence to a positive equity environment along with liquidity through year end. Get ahead in your financial journey. Sign up for the KPP Premium Newsletter and receive tailored insights every week. Let's take a quick look at the market today. It was a positive day overall. You had the S&P up about 16 basis points, so modest there. NASDAQ was up the most, up 0.78%. And the NYSE, though, was down nearly 0.5% on the day, really driven by those small caps. And the main reason here is the rise in the 10-year. You saw the 10-year rate increase once again. Now, it did rally throughout the day, or 10-year bond rallied throughout the day. So it did rates did close near the lows of the day, but it started off with rates higher. And you continue to get gyrations in the betting odds and DJT, obviously Trump's SPAC that continues to have wild volatility, right? Peaked back in March at around $80 per share, hit a recent low around $12 per share. Now it's up to $51 per share on the speculation that Trump's presidency would be good for the stock. I don't know if that would really help the Truth Social that much, but the market is certainly, I think it's just a Trump trade in general, even though the quality of the Truth Social business isn't very good. So that's really what it is, just in sympathy to the odds of a higher Trump presidency. And let's see, the dollar was about flat on the day, but the big mover once again was gold, up nearly over 1% on the day, and all to a new 52-week high. Still not a lot of people are talking about that, but clearly that is pricing in. That's really the signal here. There's two things I think the Trump presidency, or the market is starting to price in, is that yes, it would be net positive for economic growth, but it'd be even more inflationary than positive for growth, right? And both things can be true at the same time. Usually you have economic growth with inflation. It's rare to have one without the other. And so, but the question is the inflation outweighing the economic growth? And in this instance, because of what you're seeing with gold, because of what you're seeing with interest rates, that is really the signal that the market is sending here. And we'll continue to monitor this, but that's where the market is settling out at the current time.
I was wondering, for moving averages, which time frames you guys like to use, whether it's the 50-day, 100, or the 200. Thank you.
Well, on my charts, I have 4. I have the 200, I have the 100, I have the 50, and I have the 20. Those are the most consistent moving averages that I see being used, and therefore have the most predictive power. Also, every stock or index has a moving average while they're in an uptrend or a downtrend that they tend to find resistance or support at. It's usually either the 50 or the 100-day, depending on how volatile the name is, how strong that uptrend is. And something else to consider too is not just that the moving averages are a support level or resistance level, but also look at the width between the moving averages. And that will give you a good sense of the trend, the longer term trend of the move. Like I said, whether it's up move or down move, if moving averages are kind of bunched together and they're kind of sideways, well, you're in a more neutral type of environment, okay, for that particular name or that particular index. So those are the ones that I tend to use and keep on my charts. Thanks for the call. Let's go talk to Chris in Atlanta, looking at SVM. And that is Silvercorp Metals. You own it or looking to buy it?
I own it. I like the fundamentals. I was trying to get a play on silver a few months back, and I like the fundamentals, but to be honest, I didn't do a deep dive past the fundamentals. Mm-hmm. And I was looking at where its mines are, and most of the mines are in China, from what I've seen. Mm-hmm. And I'm going, even though the fundamentals are good, I don't know about that risk in there. Let's see what you thought of it.
Yeah, I agree that is a risk. Now, will that risk rear its ugly head in the near term? Not sure. Think of maybe a Trump administration that puts a lot of tariffs on China, and could they have some sort of tit for tat type of retaliation that would limit the ability for a Silvercorp, for example, to pull their earnings and their production of those mines out of the country? That's something to consider, especially with China's economy struggling over time. I do think that the jurisdiction that the mines are in over the medium to long term is important. I don't see any imminent threat, but once again, we don't know what's going to happen with the election, what type of tariffs there will be, and what type of real fight there would be between a new administration and China. And so I do think there's some risk there. I wouldn't say it's a high risk.
Fundamentally, it compares pretty well with a lot of or better than a lot of silver miners I've looked at.
Yeah, and I think that's the reason, though. That's what most people have to weigh, is that when you have this type of elevated risk, because of the jurisdiction that they operate in, it's going to trade at a discount for that reason. You see that in Brazil. You see Brazilian companies trading at very, very low valuations. Why? Because there's geopolitical risk. There's just political risk that could upend the operations in some way, shape, or form. And that's why it trades at a discount. So yes, the fundamentals are solid. I don't disagree with that, but just know that is a risk. You're getting the discount for a reason. It's not just out of the blue. It's because there is that jurisdictional risk there. So just know with your eyes wide open and make sure it's not probably your biggest exposure within the precious metal space, just because of that discount. I would rather have the majority of my exposure in miners that have jurisdictions, that have operations in jurisdictions that are a little safer.
Well, that's what I thought when I went with the Canadian miner. Then I looked and saw where their mines were. So, all right, I appreciate you.
No problem. Thanks for the call, Chris. Let's go take another live call. John from St. Louis looking at Steel Dynamics, STLD. And this has been on a nice little uptrend recently, and you own it or looking to buy it?
Oh, I'm looking to buy it. Just curious what you think of the company. I heard it has some. I heard it pitched as a steel company that was advertised as a mid-value, but due to some sort of technology they have, this person analyzing it thought it might be more of a mid-growth and a good company to have with basic materials and whatnot, being a decent sector to be in right now.
Yeah, this is Steel Dynamics, and this, along with, there's one other one in the steel industry. They're the two, I think the only two really to invest in if you're going to invest in steel. Now, the issue with steel in general is, while this is the one of the best steel producers out there, and you're right, they do have some technological advantages over the others. That's why they tend to be more profitable. So I like that. But still, steel is very cyclical, and they don't have really an economic moat that can protect them and keep their margins high over a long period of time. You just look at earnings, they exploded during the pandemic, but going into the pandemic, earnings were down from $5.48 in 2018 to $3.10 in 2019, and then it dipped again in 2020 because of the pandemic, then all the way to $22.68 in 2022. But you saw a 34% drop in earnings last year, another 32% drop expected this year to $10.22, and then down again next year to $9.85. So you're seeing a reversion to the mean here with its earnings. And the question is, where does that level out? Does it ever level out at $5? If it does, then this is still extremely expensive. So you're barking up the right tree in the name within the steel space. The question is, do you think that steel is going to be in higher demand? For example, a lot of the global steel demand has been out of China. And if they're not building as many buildings, because they're trying to deflate their real estate bubble, well, then where does that excess steel capacity go? It tends to go elsewhere, and that means oversupply, margins shrink, etc. Not to say that is going to happen, is 100% going to happen, but that's what you're kind of seeing though in the earnings, right? And why earnings continue to come down. So where does that kind of level out at, and where does the Steel Dynamics profitability level out at? That's the bigger question. Now, they have a good balance sheet, like you said. They're profitable. They have good technology. So this is the name, probably the name you want to look at in steel. It's just you have to answer the question: do I really want to own steel in this environment?
Gotcha.
Okay.
Thanks, Justin.
No problem. Thanks for the call.
Learn more about our services and insights by visiting InvestTalk.com.
Hey, Justin and Luke. Chuck from Clayton. Love the show. You guys are awesome. Got a question about UFP Industries. UFPI. I own it in my portfolio. It's up a little bit. Got about 1.5–2% of my portfolio. Today it took a little bit of a tumble because it missed earnings, But I'm looking at it, the chart of the last 10 years, been nothing but going up, and it looks like a strong company to me. Was thinking about adding on this dip and wondered what you guys thought about the company. Looking forward to hearing your answer. Thank you very much and have a great day.
All right, looking at UFPI, and this is a supplier of lumber to the manufactured housing industry, a multi-billion-dollar holding company with subsidiaries around the globe, serving 3 markets: retail, packaging, and construction. Now, $8 billion market cap, so a mid-cap, pretty much no debt on its balance sheet, no net debt on its balance sheet. Enterprise value to EBITDA is right around 9 or 10, so that's pretty good. 1% dividend yield certainly can afford that. Nice $675 million in free cash flow on a $7 billion market cap. That's nearly a 10% free cash flow yield. I really like that. Now, that has been coming down a bit from a peak around 874, but still, that's healthy free cash flow. What are they doing with that? They're obviously paying a little bit of dividend, but they're buying back shares mainly, and that's what I really like. They had in March of 2023, they had 62 million shares outstanding. Now they have 60 million shares outstanding. So not a dramatic amount, but certainly on a path towards utilizing that cash flow to buy back shares. They can't really pay down debt. They could pay a higher dividend, that's for sure. But overall, pretty good return on invested capital, right around 14%. Its 5-year median is around 18%. So I like the profitability here. Earnings are expected to fall 7% this year, but bounce back 10% next year. So, and it's in an uptrend. Like you said, it's up and to the right. You like to see those charts when you're zooming out to a weekly or monthly chart, and I can't complain about it. So I would continue to hold it. I'd probably be buying on dips because I think there's still a housing shortage in this country, and these manufactured homes will be a source for low cost housing, and I think they'll still be in demand. So I would stick with UFPI. Thanks for the call. Now, I hope you've been telling your friends and family about our podcast and the fact that it's available in video form over on our YouTube channel, and we get questions submitted over there as well. And let's tackle one of those now. Steven says, what are your thoughts on covered call ETFs such as QYLD, XYLD, and RYLD? Now, we get this question a lot, mainly because people are chasing yield. And you know what I say all the time, don't chase the yield, okay? You have to understand where the yield is coming from and know that the yields ebb and flow, and there's certain risks that you're taking when you are chasing yield, okay? So, for example, RYLD, that is the Global X Russell 2000 covered call ETF, that is a 12% 12-month yield. But if you look at the performance, let's go over here. What you will see is that year to date, it's up 7%. Last year was only up 0.28%. 2022, it lost 13%. That is total return. Okay. That's not that good. Okay. Not very good at all. Especially when you compare it to the Russell 2000 and other parts of the market. It's not doing very well. And while I don't have a problem with a covered call ETF, a covered call strategy, we actually execute a covered call strategy. It's called our Equity Income Plus. It's done very well, risk adjusted, etc. And we like that idea of rolling options on a monthly basis and collecting premium, and over time that tends to work out in the option seller's favor. However, it's all about the underlying assets, because covered calls, it brings more premium in, but it doesn't prevent major losses. If you pick the wrong companies, then you could have big downside. This is why we usually only invest in companies that pay a dividend and then write covered calls on that, because the dividends kind of keep a ballast there and make it so they don't decline too dramatically, because that dividend yield is attractive to investors. And so it's really about the underlying quality of the portfolio that the covered calls are being sold against. And so don't be fooled by the yield. Don't be buying these because of the yield. you would want to buy one of these because you like the underlying index that it's following, whether that's the NASDAQ, the S&P, the Russell 2000, whatever that is. That would be your first line of questioning. Then you say, okay, I want exposure to that index, but I want to lower my overall risk. And then this would be a way to do that. And that's really what covered calls are designed to do. Give you exposure to a particular sector or part of the market or portfolio of assets. Obviously, that's what we're doing for clients. And then lowering that overall risk by selling the covered calls. So these are not a panacea. They can be part of a portfolio, but don't be buying them just because of that yield. Do not chase the yield, as I always say. Now, as we head into the election here in 1 week, let's talk a little bit about the potential outcome. We know we're starting to see some pricing in of a Trump win. And the big question will be is what would a Trump presidency or a Kamala Harris presidency mean for the economy and markets? Now, inflation has fallen over the past couple of years from high single digits down to roughly call it 2.5%, 3%, depending on what metric you're looking at. And we know that both candidates support policies that will likely boost growth, but also boost inflation. And the big question is by how much and what is the trade-off? Is it positive or is it negative, right? If you get only a slight boost in inflation, but a big boost in growth, that's positive, right? If you get the opposite, that would be negative. Now, conservative-leaning advisors are worrying that a Trump presidency would stoke inflation more, mainly because of across-the-board tariffs on imported goods, deporting workers, and leaning on the Federal Reserve to lower interest rates. Now, the first two, in many ways, you can do through instituting tariffs and deporting workers. Both of those would be inflationary. Simple. It's not really hard to figure that out. And bond yields are starting to react to that and saying that a new Trump administration would bring higher deficits, inflation, or potentially both. And he also would probably battle with the Fed to keep rates low, even though the Fed, if they see inflation, would want to do the opposite, right? Now, the supply chains have healed a little bit and labor markets, especially due to immigration. And I would argue that that's probably one of the aims of the Biden administration, to allow the borders to be a little more open, is to bring more workers in and bring down inflation. It's pretty interesting that now that inflation is sub 3%, that those border crossings have dropped considerably. So I think there's some correlation there. But overall, the lower immigration and opposite, deportation, would certainly roil the labor markets even more. Now, you could argue that's a good thing, that rates, workers' pay would rise, American workers' pay would rise, and that would be a good thing. But clearly, how markets work, that would feed into prices and inflation. And the big question is, what would he actually do, right? I've said this many times. Both politicians of all stripes, they say one thing on the campaign trail, and then based on who's in their administration, based on how Congress ends up, it becomes something different, either by persuasion or based on just what's feasible, based on how easy it is to get through Congress. Okay, now, like I said, trade and immigration is something that Trump could really do a lot without Congress. So understand that. Now, the Peterson Institute study established that deporting immigrants would significantly reduce the economic output while boosting inflation. It's from the Peterson Institute. And it would probably lower margins if they don't raise rates, right? Because they're paying workers more. So there's an interesting study, though, from the University of Colorado in Denver. And they studied deportations carried out by Bush and Obama, so nothing under Trump, between 2008 and 2014. They actually found for every 1 million unauthorized workers deported, 88,000 Americans lost their jobs. Why is that? Well, pretty simple. immigrants typically are not working jobs that Americans want to take. They're in food processing, agriculture, construction, hospitality, don't typically compete with US workers. And so when those workers are expelled, instead of hiring native-born workers, businesses are just scale back production. They say, we can't get, think of a hotel, okay? There's certain back office jobs, think of in the kitchen. You're talking about those that clean up after the patrons, et cetera. A lot of those are immigrants, maybe undocumented immigrants. If they can't get enough people to work there, they just shut down the whole hotel, right? And that means laying off front desk workers, for example. Okay, and so that's one small example and why that report or that study showed that expelling those workers actually scaled back some domestic jobs. Now, business leaders and economists agree that U.S. consumer would bear the costs of tariffs in general. He's floated a 10% tariff on across the board and 60% on Chinese-made goods. And the best argument I think against this is that he's simply going to use this as leverage to get better deals, and maybe he will. Obviously, that didn't happen in the first administration, but certainly could happen here. So that's really what's happening in markets. That's why you're seeing higher interest rates. That's why you're seeing the dollar stronger because of higher interest rates. Right, higher interest rates means stronger dollar, means the Fed would be less dovish on its policy to try to combat higher inflation. And that's really what you're seeing here in markets. And I'm not here to say one or the other. I'm just showing you what is being expected by economists, by markets, et cetera. In fact, the Committee for Responsible Federal Budget says both Harris and Trump would be bad for the deficit. So it's just a matter of who gets their policies passed more effectively. And I think the big question would be, will bond markets handle it? We saw this in the UK 2 years ago when Prime Minister Liz Truss, she unveiled a new spending program and interest rates shot through the roof. And within days, her government resigned. And, the big question is, no matter who's elected, will the plans going forward for spending and the deficit be allowed to persist within markets? So we'll see. Now let's go ahead and roll into another listener question from our Anytime InvestTalk voice bank at 888-99-CHART.
Hi, thanks for your show. This is Greta from Palm Desert, and I have a question about Micron Technology, looking to buy, ticker MU Micron, and just curious about your thoughts on the stock and getting in on it. Thanks.
All right, looking at Micron Technologies, MU is the symbol, and they make DRAM and flash memory and image sensors for computers, servers, consumer electronics, etc. And their products are in really high demand for data centers at the moment. And earnings will go up to $12.82 next year on $108 stock. So that's a high single-digit forward-looking multiple. And the stock already pulled back, or the price already pulled back from $156 all the way to around $85 per share. Now we're back up to $108 and starting a new uptrend, making higher highs and higher lows. And I like it. I think this is, at least in the short to medium term, is refreshed itself, gotten rid of some weak hands, and is beginning a new uptrend. They have a good balance sheet, and obviously their products continue to be in high demand. Long term, it is a very, very up and down business, though. So understand that it's a business that goes from making a ton of money to losing a ton of money in a short period of time. Just look at 2022. They made $8.34, but they lost $4.45 the next year. They made $1.30 last year, so to make $8.98 this year, and then, like I said, $12.82 next year. So you can see their business does tend to be up and down, and you have to be prepared for that volatility. If you're not, then you're going to have a rude awakening. So just understand that there's a lot of volatility here, but I do like the business, and it has a scale to serve the high demands for the new data centers. So I like Micron, MU. There's another question that from our InvestTalk YouTube channel. Blackberry7 says, what are your thoughts on XYL? XYL, this is Xylem. I think how you say it. XYLEM is how you spell it. Xylem. And this is in the water space, if I remember correctly. Yeah, $31 billion market cap. They make water equipment and provide services for water and wastewater applications to the water industry. What I like is that their earnings continue to consistently gone up over time. They're a secular grower here. It has pulled back. It is in a bit of a downtrend in the short term, but if you zoom out to a weekly chart, it remains in an uptrend. It is a bit expensive though, $4.81 next year on $130 stock. It's a bit rich for my blood. I would want this to pull back. I think at 120, this would be a buy in the 115 to 120 range. That's where I'd pick up Xylem. ZXYL.
We hope you enjoyed this video.
Please consider liking and subscribing so you can stay updated with our latest content.
Got a question for you on Social Security withdrawals. So listening to you, I've learned that if you can put off your taking Social Security until past your eligibility age, that you make about 8% per year by delaying it. So I'm clear on that. Question is, how is this impacted by whether you're working during that time frame when you delay Social Security? Does not working reduce the amount of gain that you get by delaying it, or does working increase it? Does it make any difference whatsoever? It seems like it would have to, because you're working and you're contributing. That would have to increase your benefits. There's the question. How does working or not working impact your delaying of Social Security and the increase that you get by delaying it? Thanks a lot. Bye-bye.
Well, your intuition is correct. Yes, as long as you are working or paying into it and you continue to delay it all the way up until the age of 70, your Social Security, what's called PIA, will increase and your ultimate benefits will increase. Now, after 70, you start taking it, you're forced to take it at 70, then there's some other calculations and there's a lot of deferrals and things like that. But yeah, up until you take it, as long as you're working, you're paying into Social Security, that should add to your overall benefits. Okay. Thanks for the call. Great question. Now let's talk a little bit about commercial real estate. Now, there's been a lot of doom and gloomers out there talking about how the commercial real estate industry is going to be the next epicenter of economic collapse like 2008. And so far, clearly that has not happened. Okay. Now, not to say that there aren't distress issues that are plaguing many buildings and many lenders that are out there. That's absolutely the case. But what it's pretty clear is that this is a longer term issue that is likely to slowly be resolved or slowly dealt with. Let's just say that. Now, the challenge for most of these lenders is that higher rates make real estate deals much more expensive. And we know that we just saw rates bottom here recently and rise again. And prices across the commercial real estate industry, including shops, offices, hotels, warehouses, they've all fallen about 20% from their peak in 2022. But only a handful of lenders have been really hit badly by these bad loans. And a lot of the price discovery is still yet to be had because there's not a lot of deals that are happening. It's hard to value them when there's not a lot of comps. The real estate industry, there's comps. And in the residential industry, you look at local sales that have happened within that city and those neighborhoods with similar square footage, similar number of bedrooms, amenities, etc., and you can get a pretty good idea of what a property will sell for. In the commercial space, the differences in property types and sizes and quality varies pretty dramatically. And because there's not a lot of sales, it's hard to find enough comps in a reasonable time frame to say, okay, this property is worth X. And many investors continue to warn there are a lot of worse realities lurking in a lot of unsold portfolios. And so it's very opaque, very inconsistent. And that's what making heads or tails out of broader situation more difficult. And they won't know until really transaction volume picks up. Now, chief executive over at Prologis, the largest U.S. listed commercial landlord managing around $200 billion, they said that managers are posting phony baloney returns because they have not written down property values to reflect market reality during the downturn. So this is a publicly traded REIT talking about a lot of these privately traded REITs. And this is what I talk about with these private REITs, private equity, private debt funds. They're so opaque that they can kind of say whatever they want. And that's why you continue to, I think the industry is filled with a lot of phony baloney numbers talking about returns that really aren't there because there's just not enough to really pin down values of a lot of these properties. So this will be a crisis that is drawn out, but it very unlikely will be one that creates a broader financial crisis because a lot of this debt is held by private REITs, etc. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And remember, we can help you better understand your portfolio and calculate your investor risk number by heading over to investtalk.com, clicking on the portfolio review button. And this is a free and confidential service. This is InvestTalk, independent thinking, shared success. Good night.